For decades, we've been taught a simple rule in economics: print more money, and you get more inflation. It sounds logical, right? More cash chasing the same amount of goods should drive prices up. That's the textbook answer. But here's the twist. Some countries have printed massive amounts of money without triggering runaway inflation, while others print modestly and watch their economies spiral into chaos. So what's really going on here? Why does Japan print trillions of yen and still struggle with deflation, while countries like Venezuela or Zimbabwe print currency and see their economies collapse under hyperinflation? The answer isn't as straightforward as you might think, and understanding it reveals some of the most fascinating and often misunderstood mechanisms in modern economics. Let's start with the basics. When a country prints money, it increases the money supply. In theory, if that new money enters the economy and people start spending it, demand for goods and services rises. If supply can't keep up, prices climb. That's inflation. It's the classic supply and demand story. But this only happens if certain conditions are met. The money has to actually circulate. People and businesses need to be willing to spend and invest it. The economy has to be operating near full capacity. And crucially, trust in the currency has to remain intact. When even one of these factors breaks down, the relationship between printing money and inflation changes dramatically. Take Japan, for example. Over the past 3 decades, Japan has engaged in one of the most aggressive money-printing experiments in modern history. Through a policy called quantitative easing, the Bank of Japan has purchased government bonds and other assets, injecting trillions of yen into the financial system. By traditional logic, this should have caused significant inflation, but it didn't. In fact, Japan has spent years battling deflation, falling prices, not rising ones. Why? Because the velocity of money in Japan is extraordinarily low. Velocity refers to how quickly money changes hands in an economy. When people and businesses are cautious, when they save rather than spend, money doesn't circulate. It sits in bank accounts, in savings, in reserves. And if money isn't moving, it's not pushing up demand. Japan's aging population, cultural preference for saving, and economic uncertainty all contribute to this low velocity. The central bank can print all the money at once, but if people don't spend it, inflation won't materialize. This is a critical insight that challenges the simplistic view of money printing. It's not just about how much money exists. It's about what people do with it. Now let's look at Switzerland, a country that also prints money but maintains one of the most stable currencies in the world. Switzerland's situation is unique because the Swiss franc is considered a safe haven currency. During times of global uncertainty, investors flock to the franc, driving up its value. To prevent the currency from becoming too strong, which would hurt Swiss exports, the Swiss National Bank intervenes by printing francs and buying foreign currencies. This expands the money supply, but inflation remains subdued. Why? Partly because of capital controls and strong institutional credibility, but also because Switzerland runs a highly productive, export-driven economy. The goods and services Switzerland produces create real value that absorbs the newly printed money. Additionally, much of the printed money doesn't flood the domestic consumer market. It's used in foreign exchange operations, sitting on the central bank's balance sheet rather than in the hands of consumers buying bread and milk. The structure of the economy matters enormously. Then there's China, a fascinating case of capital control and monetary management. China has expanded its money supply significantly over the years to fuel rapid economic growth, yet inflation has remained relatively controlled. How? Through strict capital controls that limit how money flows in and out of the country. The Chinese government tightly regulates currency exchange, restricts foreign investment outflows, and manages domestic lending through state-owned banks. This allows authorities to control where newly created money goes, funneling it into infrastructure, manufacturing, and export industries, rather than letting it slosh around freely in consumer markets. China also benefits from having a massive, growing economy with increasing productive capacity. When you're building entire cities, expanding manufacturing output, and increasing exports, there's real economic activity to match the growth in money supply. The new money isn't just inflating the price of existing goods, it's financing the creation of new goods and services. Of course, this system isn't without risks, and China has faced asset bubbles and debt concerns, but the controlled environment has prevented the kind of inflation you'd expect from such aggressive monetary expansion. This brings us to a crucial concept: the difference between productive and unproductive money creation. When newly printed money finances real investment building factories, improving infrastructure, funding education, it can increase an economy's productive capacity. More goods and services are created, which can absorb the additional money without causing inflation. But when printed money simply floods consumer markets without a corresponding increase in production, or when it's used to finance government deficits without genuine economic growth, inflation becomes almost inevitable. It's the difference between planting seeds that grow into crops and just handing out cash with nothing to buy. Another critical factor is trust and expectations. If people believe a currency will hold its value, they're willing to hold on to it, save it, and use it for long-term contracts. But if trust erodes, if people expect prices to rise, they start spending money as quickly as possible, accelerating the velocity of money and creating a self-fulfilling inflationary spiral. Countries like Japan and Switzerland benefit from decades of institutional credibility. People trust their central banks. They believe in the long-term stability of the currency. That trust acts as a brake on inflation, even when the money supply expands. Now, let's contrast this with what happens in the United States. When the Federal Reserve prints money, especially in massive quantities, as it did during the 2008 financial crisis and again during the COVID-19 pandemic, there's always concern about inflation. And indeed, in 2021 and 2022, the U.S. experienced significant inflation, with prices rising at rates not seen in decades. Why did the U.S. see inflation when Japan, printing similar relative amounts, did not? Several reasons. First, much of the money created during the pandemic was distributed directly to consumers through stimulus checks, unemployment benefits, and loans to businesses. This money entered the real economy quickly, and people spent it. Velocity increased. Second, the U.S. economy faced supply chain disruptions, labor shortages, and production bottlenecks. Demand surged, while supply couldn't keep pace, a classic recipe for inflation. Third, the U.S. dollar, while still a reserve currency, doesn't benefit from the same deflationary pressures Japan faces. Americans have higher propensities to consume, lower savings rates, and a culture that encourages spending. The structure of the economy, the distribution of newly created money, and the behavioral patterns of consumers all matter immensely. The U.S. also has a more open economy with fewer capital controls than China, meaning money flows more freely, and inflationary pressures can build more rapidly. So what are the lessons here? Money printing doesn't automatically cause inflation. It depends on where the money goes, how fast it circulates, what the economy is producing, and whether people trust the currency. Japan prints money but faces deflation because money doesn't circulate and the population saves heavily. Switzerland prints money but maintains stability through a strong export economy and safe haven status. China expands money supply but controls inflation through capital controls and directing funds into productive investment. The U.S. printed money and saw inflation because that money reached consumers quickly during a time of supply constraints and high demand. For policymakers, the takeaway is clear. Monetary policy isn't just about the quantity of money. It's about the quality of how it's deployed, the structure of the economy, the behavior of consumers and businesses, and the credibility of institutions. You can't just copy Japan's approach and expect the same results if your economy operates differently. Context is everything. For everyday Americans watching their grocery bills climb or their savings lose purchasing power, understanding these dynamics helps make sense of why some countries seem to play by different rules. It's not magic, and it's not luck. It's a complex interplay of economic structure, policy choices, cultural factors, and global market dynamics. The next time you hear someone say, "Why don't we just print more money?" Well, now you know why it's not that simple, and why some countries can get away with it while others can't. And that's something worth remembering when you next hear debates about monetary policy, inflation, or the future of the dollar.